You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk.
Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by SWAN Global Investments. Since 1997, SWAN has been the leader in hedged equity and option income strategies with GIPS verified results. SWAN provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, SWAN defined risk mutual funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think SWAN when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it is time once again for the Advisor's Option, the program where we break down the sometimes scary, sometimes seemingly impenetrable world of options for you, the busy financial advisor and asset manager who's out there busy dealing with your clients, handling your clients' needs. You don't maybe have time to devote to the option space. That's okay. We're here. We can do it for you. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, at least we hope so, the Options Insider Radio Network. Hope you guys are enjoying the program. Judging from your deluge of feedback and questions and comments, you certainly are. So we're looking forward to getting to more of those this episode. You guys inspire us, including inspiring some of our segments like you're going to do today. So keep all that insight, that feedback, all that good stuff you're sending us. Keep it coming. We do love to hear from you guys. And if you like what you're hearing, make sure you head on out to your platform of choice. And particularly for a show like this, which is such a nuanced audience, and leave a review on your platform of choice. Help others like you discover the program. We love to see new people out there learning about the show, discovering it all the time. And you guys can help that. Head on over to your platform of choice. Leave a review. Tell them what you think. Just don't worry about the director of risk. I'll handle him. Don't worry. Don't leave your comments about him. We'll take care of that. Speaking of the director of risk, since I threw some shade his way, let's kick things off with him. I am joined, of course, on the program by my usual advisors, options, compatriots, my partners in crime. Starting off, we dial the Wayback Machine all the way out there to the land that time forgot, a.k.a. Puerto Rico, where we are joined once again by Mr. Chris Hausman, the Managing Director of Risk and the Portfolio Manager over there at SWAN Global Investments. Mr. Director of Risk, welcome back to the program, sir.
Hey, guys, gentlemen, good to be back as always. Appreciate it. And it's plenty of sun down here, so we're always interested in that shade that you just mentioned.
Yeah, you guys could use some. We'll all be heading your way next year for the big Options Industry Conference, so we'll get to sample all this lovely tropical Puerto Rico weather for ourselves firsthand. By the way, it looks like, Mr. Director of Risk, the listeners are even embracing this now, so I think it's official. Have you just embraced it, sir?
I've been okay with it. I guess, you hear the same thing over and over again, just finally accept it. So that's kind of the stage I'm at.
It's one of those things. You're on the network, you're eventually going to come away with a nickname. It's just how it rolls here. So we're still working on Matt, what would work for Matt. But Director of Risk seems to have coalesced around you. Of course, I'm talking about Matt, talking about our friend, the keeper of all the earnings data that you guys love so very much. Mr. Matt Amberson, the founder, indeed the principal over there at RIA'S, a.k.a. Options Research and Technology Services. Mr. Amberson, welcome back to the program. How are things in the land of New Hampshire, sir?
Things are lovely, and it's good to see they're adopting the Director of Risk and talking about the earnings reports. It's always good to see some feedback from actual people out there. We're not just speaking into the ether.
Yes, it is always refreshing to hear from the folks. Before we actually get to that, let's get to some of the happenings. What's going on in the options world and indeed in the marketplace, because it's time for the buzz.
Busy financial advisors and asset managers don't have time to follow the latest developments from the world of options. So we do it for you. It's time to get the buzz.
Welcome to the buzz. Like the man said, this is the portion of the show where we break down what's going on in the world of options and indeed in the market. People really like it when we spend a little time drilling into the market landscape, particularly the volatility landscape, what's going on from that perspective. So let's start there. Let's start the way we just were. Let's go back around the dial the other way. Let's go back to the land of New Hampshire. Mr. Matt, how are things shaping up in your neck of the woods, sir, currently? What we're looking at. I know you guys are running a lot of models these days that incorporate a lot of interesting variables from the volatility landscape. What are your models telling us these days, sir?
I spoke at a Texas Alternative Investments conference and was basically saying there's not a lot of fear out there right now. The contango, not just in the VIX, but in the implied volatilities of the SPY was very muted, and the implied volatilities are kind of tinkering around, going down a little bit. The actual volatility is quite low, so I was saying it's pretty good headwind, and the market's rallied since then, and it still looks pretty muted. I mean, it looks everything looks like we're in a bull market for a while, Mark. I know it's hard to say with 11 years into this thing, but it looks pretty muted out there. My New Hampshire VIX puts license plate strategy still was working. I was on with the greasy meatball Mark Sebastian on your other show and called a VIX of 12, and he nearly fell off his seat, but it got down there. So, I mean, it looks fairly muted right now, and I don't see much coming right on my charts and models, Mark.
Yeah, you were close there. I think you're maybe one show off. It flirted with it, and then it got back north of the 12 handle. Now we're back down, of course, in those interesting levels we'll have to see how it's shaping up from my prognostication. We still got a couple of days here, and we all know even intra-show how the volatility market can change. So I never count my chickens too early. Though if I am close, I will trumpet. I will toot my own horn a little bit. I know from previous experience that could be a fleeting thing. Lately, though, it's been working out pretty well. Multiple, actually, pretty much bullseyes for me going on there these days. So my track record pretty good. Let's see if I can keep it up into this week's show. Let's go back around the dial now, out to the volatility mecca known as Puerto Rico. Mr. Hausman, sir, what has been lighting up your tape? What has been dominating your perspective as you're out there rolling and adjusting and managing the risk over there in SWAN Global Investments, sir?
Yeah, Matt hit it. It's really the lack of volatility, which just happened overnight. I mean, the first 9 months of the year was kind of, I think the jury was out whether premium sellers or being long premium. Nobody knew who was going to win 2019, but as soon as the announcement where there was going to be more QE light or whatever they're calling it now, I mean, volatility began to collapse, with the rise, the concurrent rise in the marketplace. So I think, one of the big stories is if you look at historical vol in the S&P 500 and the SPX, it just hit a 2-year low last week. If you look at VIX, VIX futures positions, speculators are very, very bearish right now. There's a very large short interest in VIX futures positions. So I think there's some, I don't anticipate anything to happen for the rest of the year as well because of, central bank easing, which they've been masters at over the last 10, 11 years. But I think there are some things building up where there could be some type of vol event. But again, is it going to last? Probably not. It'll be an episode that we've seen in the past, and then it'll correct itself moving forward.
Yeah, we are in kind of these weird times. I mean, I was just looking for one of our other programs recently. We break down a lot of the paper in the volatility space, and the paper out in VIX land, a few days last week notwithstanding, has been anemic. The ADV is threatening to break 300,000 to the downside. Those are levels we don't traditionally see outside of maybe the dog days of August and maybe right around Christmas. In a usually quiet and tranquil holiday season, that's what we see. But we're seeing that right now, which is interesting because we have so many irons in the fire right now. We have earnings, we have trade war, which seems like it's driving the market back down again today after all this optimism. Oh, we have a trade war. It's just pretty much a done deal at this point. All we got to do is dot the I's and cross the T's. Now we're hearing maybe not this year. So the trade war is a gift that keeps on giving or taking, I suppose, depending on your perspective. A lot of other deals, Middle East, everything else, a lot of things being stirred into that cauldron, and yet we're seeing extremely anemic levels of both volatility and volatility volume as a result, which is kind of interesting. Before we get out of the buzz, Mr. Matt, this is your time of year as well. It's kind of always your time of year because earnings is the gift that just keeps on giving. As soon as the season's done, it's right back into it again. But we still are in the teeth of it. A lot of big retail names popping off this week, and a lot of big names have popped off since the last time we spoke. I know last cycle, you were talking about how it was kind of the extreme outlier in terms of blowing the doors off a lot of different straddles. This season, it seems like the trend is the opposite, sir. People are underperforming straddles that are already kind of cheap. Is that your take as well?
Mark, you had to rub it in. Retail stocks and holidays. My wife said we got to buy Target. She loves everything at Target, and so we bought a little bit at 70 and sold it out at 79. Honey, we made $9 on it. Now 125 today.
Oh, geez.
13%.
That's the new dangerous wife shopping trip. She goes, she spends all the money at the store, then she comes home and wants to buy the stock. That adds a new wrinkle. That adds a new layer of expense to the trip, sir.
So they had earnings this morning before the open, and they're it's a good stock, and you should listen to your wife. Just that's I just got to put that a big Post-it note on my monitor here. But this earnings season's been interesting. So what we do at ORAS is we break it down by the 6 weeks of earnings. Earnings start, quarter ends January, April, July. This is the October quarter end, runs for about 6 weeks. We've got 94% of firms that have already reported. Started off extremely bad for option buyers, and then it got a little better still, and we were calling this is the good week, and it was the good week. The number 4 is the good week. So that people owning options made 15% on their holdings, and so that was the best week. And then it's kind of come down. But right now, Mark, the implied earnings move from the straddles versus the actual earnings move, 5.9% versus 5.9%, 100%, even, 0. So
wow. Has that ever happened before? Obviously, we're not done yet.
I haven't seen that. So we're right at break even right now. Again, win ratio right about the national average. When I say historical average, I should say that was back 12 quarters. That's 39% winners. 61% people losing owning options, but the magnitudes of the moves are bigger on the and it gets the actual versus implied to 100%, Mark. So that's what's going on in the earnings right now.
I guess we have another outlier season. We had an outlier season last season from an outperformance. This time from a statistical dead heat. That in and of itself is an aberrant scenario. So that also an outlier itself. That's interesting. I hadn't realized they had caught up. Because I know you're right. Earlier in the season, it was leaning in one direction. And now it seems like we are in a statistical dead heat. Who will win, listeners? The premium buyers or the premium sellers? You got to stay tuned to find out. And, of course, you got to keep checking the earnings move and earnings move results. And, indeed, now the earnings season reports. You can find all that over there, of course. TheOptionsInsider.com. Click on that Options News and Articles tab, top right of the homepage to begin your journey. And, of course, if you want the deep dive, ORATS.com, ORATS.com. The place to go to kick the tires and light the fires. Let's light those fires right now because you guys are really the wind that fills the sails on this show. You really keep sending in great ideas. So let's do it with a little bit of the old tricks of the trade.
And now it's time for practical advice on the best tools, tips, and techniques for implementing options into your practice. It's time to learn the tricks of the trade.
All right, we're going to get to that. But first, Mr. Director of Risk, I can see you're chomping at the bit. You have a burning question about some earnings volatility. So have at it, sir.
I do. It's obviously for Matt here. But have you noticed a trend towards that, like where actual and implied is kind of trending towards, this break even, or is it just kind of a flukish, or has it been kind of random still? I mean, I guess coming from where our market's getting more efficient, are people getting better at pricing options and pricing these moves after earnings?
Yeah, good question. So what I've been seeing is they're getting so much better at adjusting. So usually the implied, so we look at the historical moves and what the moves are in the market today. So that's usually around, I don't know, over 96%. So it's usually the implieds versus the past moves. But this earnings season, it was much higher, so they adjusted higher. So I guess the answer to your question is it looks like they're getting a lot better at adjusting. And I think what must be happening is the amount of surprises and the amount of, volatility in the marketplace is being predicted better. So yeah, great question, Chris. I think they are getting better at predicting, what are the moves going to be.
We're getting better at taking a lot of your feedback, like this one. This segment inspired by a listener, Derek, the creatively named Derek. He wanted to know, are there any option strategies that you feel RIAs should flat out avoid? He says, he adds on an addendum here. Matt, you'll like this. Thanks and love the earnings reports. Any chance of sector earnings updates, maybe tech earnings or retail earnings? Matt, you give them an inch, they take a mile. You give them a whole bunch of great free earnings about straddle data. They're like, how can we parse it a little bit better? But you know what? We love the feedback. It's all good stuff. So maybe we'll start there, Matt, since you are invoked in this question. I'll give you pride of place. First off, I guess answer the second part of his question first. What about his idea for, tech earnings and that kind of fun stuff? People might like that. And then B, let's get to the meat of the question. We've talked a lot on this show about funky. In fact, just last episode, we talked about multi-leg strategies that could be prohibitively expensive, maybe used to be, but now are a little bit less expensive. So maybe are there any out there, as you're thinking about it, you think a lot of our RIAs should maybe stay away from?
So I'll answer it in the order that you asked it, Mark. So I agree that especially mid-earnings, you're going to have so many earnings, so we should slice and dice it. I hear that. You've been asking for that. You are the leader of the earnings design, so I'm very appreciative of you. I
am just the voice of the audience, sir. They speak through.
Yeah. And then, strategies that are RIAs should avoid. Yeah, I mean, obviously we do a lot of back testing, a lot of working with RIAs and funds. I was knocking on the door. They shall remain nameless, but I was knocking on the door trying to get back testing and some of our Monte Carlo simulations in for this one company that was doing ratio spread, so even premium, but they're long one and short many. So you should. My thing when I was a market maker and backing market makers is always be flat, at least flat units. So watch your units. So, I mean, RIAs, listen to that, please. I mean, just don't be short units is the big thing. That's all. I'll just leave it there and just let that sink in.
That is good advice. That's kind of the old school market maker coming out in you. I think we all have that beaten into our brains at an early age on the floor of, don't get crazy naked short, because we all know that strategy works until it doesn't. And when it doesn't, man, come back to bite you. So there you go. That's one caveat. Mr. Director of Risk, it is your job to direct risk. So when you're out there directing risk for RIAs, maybe talking to these guys at your 10th box events or a lot of the other educational outreach you guys do over there at SWAN. And maybe you've encountered this question before. What would you tell them? And indeed, our listener here, Derek, what should RIAs tend to avoid from an options perspective?
Yeah, I think I'll take a step back, and then it starts with defining what your goal is. And then after you've defined your goal, whether it's income or capital preservation or maybe a combination of the two, and then what is your risk tolerance? So I don't want to necessarily say avoid a certain type of strategy, because I think every strategy has its day. And Matt, with the back testing that he provides, that's why it's there. It's defined under what kind of environments certain strategies work or don't work. But I think as a general rule, if you are starting out, I would probably avoid using leverage. And that kind of fits in the theme with, don't be too short many units. That seems to catch people off guard when they trade too big a size for their accounts. They're doing Reg T and they're doing a little bit more than they should, or especially in a portfolio margin type account where you can add additional risk on there. I think that's been one of the biggest mistakes that I see, is that people trade too much and the size is too much from a leverage perspective.
Well said, sir. Yeah, our audience, they want us to give these specific prohibitions. This prescription list of things you should not trade. And there are a lot of caveats that go into it. A lot of things that depend, of course, like you just mentioned, Chris, on what type of strategy the RIA is pursuing. It's a different ballgame for a long equity guy versus someone who's maybe a little bit more deep in the weeds, doing something a little bit more hardcore, versus someone who's maybe just straight up T-bills. There's a lot of different things. Also, T-bills, going back to the risk outlook. What is your client's risk outlook? If you have a grandmother who's retired and looking to live on capital preservation is the number one thing, you probably shouldn't be out there blasting away at extremely aggressive premium harvesting type techniques and everything else that could cause a huge hit to that capital at the end of the day. So the client's risk tolerance is another factor. And, of course, market conditions. If vol is extremely low, go back to the nadir of volatility back in 2017. Another time where maybe you should be looking away from getting income and maybe looking to buy some options. So there's a lot of moving parts to this. But, I can see Derek wants a list, wants some strategies you should avoid. So I'm just going to throw one out there. Here we go. How about this? Ratio iron condor swaps. How about that? They should avoid that. Can you guys all get behind that? Matt and Chris, let's just put it out there right now. RIAs should all avoid ratio iron condor swaps. Can you guys agree with that?
I'll avoid that too, Mark.
Yeah, I won't disagree on that one.
There we go. I think we can all coalesce. So everyone out there who wants a specific strategy, you should avoid. But yeah, in general, those caveats are all in place. Breaking it down a little bit further, looking at long equity, for example, which is a lot of the RIAs out there. A lot of them are skittish, and rightfully so, from option strategies that will add to that long equity position, maybe in ways they didn't anticipate or don't want. So that means a lot of naked short puts. That also goes back to Matt and Chris's prohibition against naked short units. Probably put spreads if you're going to do it that way to keep the risk mitigated. And also, remember, you could end up getting long more equity. So that's why we always counsel when you're doing those type of strategies to choose a strike where you're comfortable buying the underlying. Because if you're not, you're going to be adding to your position, perhaps in a way you don't want. So that's something a lot of long equity managers need to keep in mind. And again, anything overly complex, I was joking obviously about the iron condor ratio swap because it's a ridiculous thing, but anything like that, super complex and extremely time consuming. The one thing we hear and push back on using options from a lot of RIAs, and I'm sure if Eric was here, he spends his days, talking to RIAs all over the country. The one common complaint he hears as well is just time. I don't have time to babysit this stuff. So if you're putting on extremely complex things that require a lot of management, make sure you have that time. If you're busy out there with a lot of clients, maybe you need to put it in the more quarterly covered calls and things like that, things that are more reasonable from your time management. And that's a big factor for RIAs is time management. And that also goes back to duration as well. If you're going to be trading very short duration contracts, like in the weeklies, for example, if you're going to do premium harvesting in the weeklies, you need to be on top of that all the time until it expires. And if you can't devote that time and that attention as an RIA, you should avoid those types of products. So those are kind of my caveats, my rules of thumb. I'm sure we'll think of more as the show goes on. Speaking of the show going on, you guys asked so many great questions. I want to make sure you guys get a lot of time on the show today. So without further ado, let's keep on rolling and hang out our shingle because it's time for the office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, let's do it. Let's see how many of you we can get on the show today. You guys are deluging us, overflowing our inbox. We need to make this show weekly just to keep up with the pace of your questions. All right, let's start with a lot of people have, not surprisingly, have thoughts on the topic that dominated our tape last episode, which was, of course, this zero, or in the case of options, close to zero, I guess you could say, cheaper commissions, not really zero. But we'll get to that. I'll start off with Crosby. Crosby wants to know, I don't get why people are saying commissions have gone to zero when they are clearly still 65 cents a contract. Am I crazy? Yeah, that's something I've been careful to point out. We've mentioned a lot on this network. And we talked about it last week on the show, or last episode, I should say, on the show as well. Zero commissions are the headlines. That's the hoopla. Schwab's out there beating that drum. All the big brokers have adopted them now. Fidelity, our friends over there on the Option Block Show have done it as well. But you should be careful to note that that's for effectively your stocks and your ETFs and those kind of more basic Delta One type contracts. You're getting into the weeds like we are with options. It's still pretty much 65 cents a contract. That's not free, not by a long shot. There's no ticket charge anymore, so that's nice. But everyone knows the ticket charge at the end of the day wasn't really where you were getting hit. You were getting hit on the contract. So that contract charge is less, but it's still there. So anyone out there who's thinking that they're free, yeah, they're not. We have another comment along those same lines here from Brian Campbell. He says, I complained about the fees per contract for my fund. For my fund to TD. I don't mean to laugh, but I heard a similar story recently, Brian. My fund to TD, and they, quote, generously offered me 65 cents. Next thing I know, they're offering the same, quote, deal to the world. So much for my special rate. Ironically, I heard something very similar from a fund not too long ago, actually, and that same kind of complaint. You're not alone, Brian, but I encourage you to get out there and maybe renegotiate that deal, particularly if you're doing some size, because like you said, that's not really a deal anymore. Everyone's getting that. So if you're doing decent size, call up your broker, whoever it is, TD or anyone else, and say, hey, what can you do for me? Usually they'll be happy to work with you, or you take your business elsewhere. And we got one more here on the fees before we get everyone's got fees on the brain. Before we open it up to everybody here, let's see. Nelson wants to know, do large options players like SWAN still pay 65 cents per contract for their options trade? Well, Mr. Director of Risk, I don't know how much you can go into your proprietary arrangements with the various brokers out there, but maybe let's start off. Obviously, we've had a bunch of questions about fees. People are all up in arms about fees. So what do you think about Crosby, who thinks people are crazy when they say it's free when it's clearly not? About Brian, who says TD offered him the quote-unquote great deal, only to find out everyone's getting that deal. And C from Nelson, who specifically has a question for you, who wants to know if you can open the kimono a bit. So what's SWAN paying these days?
Yeah, it's certainly not free. So the two things that dictate, and like you said, I mean, they're negotiated rates between brokers, and brokers will charge differently depending upon whether you're executing it directly yourself or we're sending it to a broker, for example, that's literally standing in the S&P 500 pit, at the CBOE and the SPX. But it's going to depend on the product. How large the product is, dollar-wise, that's number one. And then number two, how many contracts we're trading. So we pay anywhere as low as 15 cents a contract to as high as $1 a contract. And again, it's going to depend on who we're executing through, how many contracts we're trading, and, what the size of that underlying index is or stock price.
That's a good point about the execution, too, because you're right. The high-touch stuff, or if you're calling up an SPX floor broker, that's a different beast than if you're just hitting click on platform Y or platform Z out there. So as you mentioned, Chris, there's a lot of moving parts to this, like there is for everything pretty much in the options world. But yeah, if you got offered a deal that everyone's getting now and you do decent size, and it could be anything, even more than a few hundred contracts a month, call them up. Doesn't hurt. The worst they could say is no, right? You can always ask. All right, Mr. Mez, next up here. He wants to know, should I be concerned that nearly a quarter of all options-based funds were launched last year? Not exactly a strong track record. And he includes a link. I believe we talked about this earlier in the year. This is a breakdown of the Morningstar options-based fund category. We talked about this category many times here on the show and the myriad problems we have with it, not the least of which that it just lumps everything options-based together, regardless of the fact that many of them have extremely different outlooks and extremely different objectives and extremely different trading methodologies. None of that matters. It's options-based, so it's all lumped together. But that's a conversation for another day. He's pointing to the fact, and he actually links to the breakdown, I think Calamos did this, of when these funds were launched in the options-based category at the time of this report, which I believe was earlier this year, right around Q1. There were 89 funds in the options-based category. 40% had been launched pre-2015, so that's in the SWAN category. You guys were way before 2015. You were one of the earlies in this space. And then 36% were launched between 2015 and 2017. It's not exactly long either. And then 24%, almost a quarter, like he points out, were launched in 2018. And they even mention here in this infographic, 6 out of the 10 funds. So 60%, for those of you bad at math, in this options-based category at Morningstar have a track record of less than 4 years. Mr. Director of Risk, we'll start with you as kind of the representative of one of the OGs here in the options-based category. I guess this is kind of a good thing for you. This probably drives a lot of phone calls for you guys because you guys clearly outpace the vast majority of the funds in this category, sir, at least from a track record perspective.
Yeah, it's. I actually spoke about this at the Risk Management Conference when I was there in Germany a couple months ago. So there are a lot of funds. This space has grown tremendously because there is a need to use options in a portfolio. I mean, again, whether it's for income or capital preservation or, like I said earlier, a combination of both. But, one of the things I said at the conference is, and again, we've touched on it here many times, is know exactly what the fund is trying to achieve, because there are a lot of different type of options-based funds in there, whether they range from put rights to covered calls, which are synthetically the same, to limited risk type strategies, iron condors. You see calendar spreads in there. Then you see the hedgers that are doing collars. So there's a lot of different strategies out there, but many of them kind of mimic each other in a way through synthetic relationships. So I always tell people to, when you're looking at any of the options-based funds is, go beyond what the simple strategy, I don't want to say the simple strategy, but go beyond what the overall goal is and keep in mind what the X factors are, such as leverage, liquidity, and what kind of risk controls they employ.
Yeah, we've said it many times. We'll say it again. I'm sure it won't be the last time we discuss the Morningstar options-based category. It's good that they finally added options back into their analysis. That's something they were lacking for many, many years. But just this one-size-fits-all approach, not exactly up to the standards of the space. Mr. Matt, same question for you, sir. What do you have to say here for Mr. Mez? He wants to know, should he be concerned that the vast majority, a quarter of them were launched last year and 60% were launched less than 4 years ago from an options-based fund perspective, sir? Is that alarming to you?
That's interesting. And looking at the report was interesting, too. I was shocked at how big the options category is. It's the 5th biggest. It's $20 billion. First is 46 billion, and that's multi-alternative. Long short is 30 billion. So I was shocked at how much, and yeah, a lot of people are adding. I think they're understanding, and demystifying options. So I think everything that you and Eric and all of us are doing is helping in some way. But I also think that the last graphic is interesting on this report that shows what is happening in certain quarters. So, for example, they break down Q1 of 2018 and Q4 of 2018 when there was a lot of volatility. That they had they show the biggest gain in the category of options and the biggest loss in the category of options. And what it looks to me is a lot of these are very short vol centric. And so, as Chris talked about before, it's a crowded trade now, short vol. We would hope that it would, or at least I would hope that it would be a little bit more diverse, so you could choose. But obviously, it's been very difficult in an 11-year bull market to show any returns in a long vol fund. So that's what's sticking out to me. I'm actually quite encouraged by the size of this. That had to have been a pretty big growth, Mark.
Yeah, you can pat yourself on the back for that. And you too as well, Mr. Director of Risk. You guys have been no small part in spreading the word out there about advisors and asset managers and options. So I think maybe some small part of that explosion on the tail end is due to a lot of the outreach we do, and of course the folks at OIC and everybody else out there, even a lot of the exchanges trying to get the word out there about options for how funds should be using these things. All right, we can keep patting each other on the back. Sounds fun, but we have to keep on rolling with the questions here. C.R. Lane is up next. Kerr Lane. Let's go to C.R. Lane. I like that better. He or she wants to know, well, first off, thank you for creating this network and for providing quality content like the advisor's option. It is my constant companion at my office. Well, thank you, Mr. C.R. Lane. We're very happy to hear it. Folks like you are the reason we keep doing shows like this. We love it. You guys love it. Everybody's happy. Oh, he goes on. Oh, he's got a question for you. Mr. Director of Risk, I don't know. You're going to start getting a big head with me on the show here. You're getting all these questions coming in specifically for the Director of Risk, so I don't know. I might have to start filtering some of these out here. He says, my question is for the Director of Risk. I understand that they offer their DRS strategy using the SPX. I would like to know if they have evaluated this approach for other indices like NASDAQ or Russell. Does the different volatility structure of these products make them more or less suitable for the 2-year versus 1-month approach of the DRS? Thank you. Interesting question. Kind of getting into the weeds of what you guys are doing out there. Obviously, you're doing long-term hedges against nearer-term income and premium harvesting in the S&P. What do you have to say for Mr. C.R. Lane, Chris, who wants to know if you guys have evaluated this for other indices?
Yeah, it's a great question. We actually offer the defined risk strategy on multiple indices. We have it currently on small cap. We have it on foreign developed and emerging markets. So, all of those products do trade a little bit differently. Emerging markets is probably the most challenging of all of them. With respect to, how volatility in the long-term space versus the short-term space acts. So, yeah, we have to constantly reevaluate that, especially, some of these other products that aren't as mature, if you will, such as an S&P 500. And when I say mature, meaning, the liquidity, everybody is watching the same product and the same volatility, and it generally acts the way it kind of should have for the most part, kind of like going back to Matt's example earlier where the implied was pretty dead on to statistical or historical volatility with earnings. So it's kind of, those are smoother products. Some, emerging market type of products a little bit more challenging with respect to managing that 1 month, or the shorter term vol space where we're short premium versus a longer term vol. And again, the reason we hedge out there on the longer term space is really these products are built for bear markets. I mean, they are not built for 5 and 7% type corrections. It's built for a larger type of drawdown. And unfortunately, over the last 11 years, we just have not witnessed that kind of event.
I guess fortunately or unfortunately, depending on your perspective, all the bulls out there are like, woo, thank God. We haven't seen that yet. Let's see what else we're seeing from the listeners here. Miles, you guys are all over the place, and I love it. Your questions are far-ranging. Miles wants to know, what's the best options conference for advisors? Oh, that's it's kind of a shallow pool, that you're drawing from there, Miles. If they still did it, I would easily give the nod to what Eric and his team at OIC used to do. They used to have a special one or sometimes multi-day RIA-oriented options event, usually coinciding with the Options Industry Conference every year, where they would just specifically tailor content for this exact audience. So that was kind of the only game in town. I don't think they do that anymore. At the very least, I think they've curtailed it, so it's a couple of panels maybe during the OIC conference itself. So I can't really recommend that one anymore, even though I probably would. Outside of that, Chris just mentioned it earlier. He spoke at the Risk Management Conference in Europe. That's probably one of the last of the Mohegans in terms of events that has content tailored for this space. I've been to many of those. There are a lot of RIAs in attendance. There also are a lot of panels on topics that would interest this audience, like how to utilize different products. A lot of them are SIBO focused because it's a SIBO event after all. But if you're okay with SPX and VIX and things like that, and analysis of premium harvesting in those types of environments, and RMC is a good place for you. Also, a lot of interesting topics in panels with people like the gatekeepers to various big pension funds and hedge funds and other investors, and how they could maybe get lured more into using options or into that kind of stuff. RMC's an interesting event. And outside of that, it's kind of in the weeds. I know, Matt, you do the conference trail. You say you're just speaking at an alts conference in Texas. You've been to RMC many times. I know you've been to OIC. What do you have to say here for Mr. Miles, who wants to know what he should be attending if he's looking for RIA-based options content?
EQ Derivatives does a couple that are interesting I've been to. And, like you said, the alts one was a lot of fun. And, I had some good feedback from that. And just to echo what you said, I love the one that Eric did with the OIC. I wish he would do that again. What do you think, Mark? I think we should put a conference together and get something going.
The Advisors Option Conference. Well, there you go. I'm sure my team is listening to this, and they're like, oh, God, no, another event. We haven't done those in a little while for a variety of reasons, because in-person events are laborious and time-consuming and expensive and everything else. But, there clearly is an audience for this, so maybe that's something we should consider. Of course, I'm leaving out one of the one of the big players in this space. I was saving it for him so he could bring it up himself. Of course, Mr. Chris, you guys do a little event every year. Has been in Chicago the last couple of years, but I know you move it around quite a bit. Why don't you regale our listeners with what it is you guys do specifically for this space, sir?
Yeah, I think some of the smaller conferences are much better for the RIAs. We've been, like you said, every year we have a conference that's specifically for RIAs. So everything is custom tailored to what they want. We already understand what their goals are and what they're trying to achieve. And so, the strategies that we talk about is really catered towards them. Whereas opposed, if you go to an OIC conference, there's going to be a lot of industry speak. So I don't think all the material is valid or for an RIA, and also the RMCs. They can get a little bit more, or especially the EQDs when you're just very vol-centric. I think there's takeaways for an RIA in all of those conferences, but I kind of agree is if you can put conferences together that just focus on RIAs and what their needs are, and you kind of hold their hand through, the options-based category and what all these, firms do and what they're trying to achieve. They appreciate that, and that they get a much bigger takeaway than just sitting, in some of the bigger industry-type conferences that we attend regularly.
Oh, Matt, our producer here heard your suggestion of an event, and she is already rebelling in my intra-show chat. So see what you've done to me, sir. You have already got me in trouble with my team suggesting events. Let's quickly roll on from this before I get in more trouble here. Let's go on. Next, we've got Tony Kyle. Tony wants to know, what are the panelists' thoughts on annuities? I love panelists. People think we're a panel at a conference. Okay, I'll allow it. Let's see. What are the panelists' thoughts on annuities? Sales appear to be soaring. What does this mean for the options market? Is this really just a way to get indirect derivatives exposure without diving into the deep end? Does this hurt options volume and growth? And he includes a link to an article that's entitled Sales of Variable Indexed Annuities Shine. And I haven't had a chance to click through all of it, but it did say sales of a lot of these products across the annuity spectrum are very robust right now for a variety of reasons. I've been on record before on this network, maybe on this show as well, never really been a big fan of annuities for a variety of reasons. This falls into the same product, or same problem, I should say, a lot of these structured products fall into as well. A lot of them are very poorly constructed. A lot of them charge onerous fees to not really deliver a lot. And a lot of them, as you kind of referenced there, are kind of backdoor exposure to derivatives that people may or may not, A, understand, B, be comfortable with if they knew what was going on. So there's a lot not to like. Obviously, I come to it from the options perspective, so we always prefer people to, be able to construct and do these types of things themselves. That's why we do this show, so you could arm yourself and indeed your clients, or if you're a client, your RIA, with the knowledge so they could improve all these things and do them all for you. But at the end of the day, we realize some people are not in that situation, and maybe for them an annuity might make sense. But it's never been my preferred go-to. Let's go back around the horn. Mr. Matt, let's start with you. What are your thoughts here on this apparently booming annuity market, sir?
Yeah, I have some of the same concerns that you voiced. I own some annuities, and they were opaque. It was difficult to figure out exactly what they were doing, what the positions are, what their exposure was, what was the risk, what if this happens, what if that happens, and the fees were sometimes high. So I've gotten soured on these. Maybe they've turned it around here. It looks like they definitely are growing, and I could see how with maybe tighter markets and the option markets and more sophistication and AI, maybe you could produce these better. And but I'm always a little bit leery of not knowing exactly what their risk is and what their rules are and all that, Mark.
Yeah, all this end of the space, this structured product annuity type of the space, not really my cup of tea. You're never going to hear me come on this network and say, oh, you should embrace an annuity, maybe for a very, very small subset of the audience. But even then, they're usually on the most sophisticated side of the spectrum, so they don't really understand what they're getting. So it's very, very infrequently, if ever, that I will ever come out and say, yes, you too, you should dive into an annuity. They all sound good on paper. You start digging into the prospectus of what they actually do, and more importantly, what they actually charge. Usually it's not quite as advertised. All right. Does it hurt options? Interesting question. It could potentially, but that supposes people have the wherewithal to understand that annuity is giving them some sort of exposure that would be analogous to what they get in the options market. I think a lot of the users don't really get that. So I'm going to go out on a limb and say probably no, but it's an interesting question. It's not one I've ever really seen analyzed in an empirical perspective. Here we go. Maybe we'll give Matt some homework on the data side. Crunch the numbers. Annuities. Are they hurting options? I have no idea how he could do that, but it's a fascinating thought piece nonetheless. Let's move on here. Got so many of you here on the show. I love it. Patrick, this one sounds familiar, Matt. Tell me if we answered this last show or not. Maybe it snuck through again. Patrick wants to know, maybe Patrick, if I want to buy an option during earnings season, should I buy it early or right before the announcement? Did we do this one already, or am I crazy?
No, you do a great job of checking off your questions at the RIA'S. There was a similar one.
Okay, well, let's go for it then. Let's answer, Mr. Patrick. You're the keeper of the earnings data, sir. Also, you have new homework of analyzing annuities' impact on options, sir.
Yeah, I'm thinking that your cohort there tried to get back at me for giving her more work.
That could possibly be.
So it's difficult to say, and just there's a lot of back testing that we have. Our back tester allows you to set the days before earning, and you could get out before or after earnings, and so you could test a lot of these strategies. So it just depends on certain names, and but like Chris was alluding to, there's they've gotten so much better, the market makers and funds and such, at predicting what the moves in these stocks are going to be, that it's difficult to find edge. You really got to do your homework. So it's a lot of back testing. It's trying to find a niche and trying to figure out, is there anything else that I bring to the table? What's my competitive advantage? Maybe a fundamental analysis that you've put on these stocks, and then now you could back test them. So I would say there's not one answer here. Go test your strategy and bring something unique to the table, and see if you can make a little niche for yourself. Mark?
Yeah, it's funny because I've heard a lot of analysis that in the past that have said buy your option maybe a little bit farther out from earnings if you're going to do it, because decay doesn't really hit you too hard until the event itself. So you kind of get a few days, maybe a week of not quite free swings of the bat, but much lower cost from a decay perspective. I think on the last show, Matt, you were saying you actually like it the other way. You like buying your options right up against the events. And you're the keeper of the data, so you would know. So it is interesting. There are, like we've said, a million different ways to skin this earnings cat, and not all of them are right, not all of them are wrong. It's an interesting beast. And again, even as we just mentioned at the top of the show, it depends on the cycle that you're trading it on. Some are crazier than others. This cycle, it's an exact dead heat, premium buyers versus sellers. So it's a crazy, crazy roll of the dice, which makes it fun for a lot of you out there. We get it. But unfortunately, there is no silver bullet answer. At least if there was one, I'd be on my own island right now. Matt would probably be right next to me with a much bigger island because he's got the data. All right, let's go on here. We could talk earnings for days here. Let's go on to this next one here from Slape. Let's just go with Slape. I like that. Slape wants to know, what is the minimum trade size for a flex order? I'd like to construct something approximately 5 years out in SPX, 20% out of the money calls. If you're not familiar with flex, listeners, this is effectively coined and concocted over there in the land of the SIBO back in the day. Effectively, it was for large institutional clients who wanted to trade something. It was a lot of times in the SPX, could also have been in the OEX or even VIX now or anything else they trade for this. These days, they'll do a flex on just about anything. But it usually was something that you wanted a little bit outside of the standard listed contracts. Could be, as Slape here wants, something a little bit longer term. Could be something that falls outside of the traditional expiration cycle. You want it on the middle of the month, or you want a different strike for whatever reason. If you were willing to do enough size, they would quote it for you. So that brings us back to his question from Slape. Chris, I know you guys do mostly listed stuff, but you guys might play in flex every now and then. Do you know what the minimum is these days to get some good flex action going?
Yeah, we do all listed. Not that the flex is a listed; it's just catered, like you said. So no, that's a great question. I don't think there is a minimum. I haven't come across anything that says there's an actual minimum. I do know you can trade these things 15 years out. So, and I was just thinking about this question because I was wondering about flex volume. Has it increased lately or over the last few years as opposed to 10, 15 years ago before we had 1,000 expirations listed? So I wonder if flex volume has actually declined or increased over the years due to all the expirations being listed. So, but no, I am unaware of a minimum. I don't think there is a minimum, but I'm not 100% sure.
Matt, I don't know if you played around too much with flex back in the day, but any insight on this one, sir?
Yeah, the one contract is the minimum, and yeah, we used to do because we had to do a couple one contract flex when I was down there trading.
I'm sure you gave a nice tight market for that one lot, right?
Yeah. And as far as the flex volumes and such, the OCC has a pretty good weekly statistics on flex options, and you could go through it, and it's interesting. The OCC.com web apps weekly volume reports, and you could see what the flex option volume has been, Mark.
There you go. I knew you were the keeper of the data. Yeah, I think, like Max said, he has put up one lots before, so it is possible. I don't think you're going to get the tightest market where he wants a 5-year out, 20% out of the money SPX call. I don't think the market maker is going to be too inclined to give you too much tight if you go in for a 1 lot or a 5 lot. But it sounds like you can get it done. So there you go, Patrick. Hit up your broker, see if you can put that through, and see what they quote you. It's going to be wide, so be prepared for that. But if you want to do a little bit more size, maybe you could tighten that bad boy up a little bit. Maybe tell us why you want this particular trade. Maybe we could steer you in some other listed, more easily executed directions. All right, next up. I think that was Slape. I think I said Patrick. Slape. There you go. All right, next up, Lambert, maybe Lambert if he's French. Maybe it's Christopher Lambert of Highlander fame. We shall see. He wants to know, is there a good place for a list of options-oriented advisors? Oh, this is where I wish Eric was on the show because he would rattle off 5 names of firms off the top of his head. There are a few vendors out there that will do this, that will provide lists of registered RIAs and things like that. The problem I've had with these, and maybe Chris or Matt, you guys can speak to this as well, I don't know, but in general, the problem I've had with this is because we're coming at it from an options-oriented perspective, and I assume you are as well there, Lambert. Let's go with Lambert. It just sounds fancier. That when you start trying to drill down in these lists of what the RIAs actually do, it gets very vague very quickly. And usually if you want to find anything RIA with an options perspective, usually you pretty much have to just search for alts. And that's kind of about it. You can't go through and say, hey, I want to find RIAs in my area who write covered calls. Yeah, good luck with that. It's not really that level of granularity. I would love that. That would be awesome. But I've never seen that. Excuse me. The best I've seen is here's an RIA in your area who may or may not do alts. It's not exactly the most useful of things. People have said, hey, you guys should compile this data. It's one of my many legion of other businesses I should be running in addition to this. So there is an opportunity, I think, there. But getting that level of granularity from an RIA, too, because if you ask them, like, oh, sure, I do that. So getting that level of granularity, I think, is a bit of a challenge as well. But in general, now I want to maybe table this for when Eric is back on from his global tours and to see what he has to recommend. I'm going to put this in until we get back to this. But this is one where I've never had great success with this. And so I'm hesitant to recommend a particular vendor. A lot of them are expensive as well. So if you're going to pay money for it, it's not really worth it yet. But I could be mistaken. There could be a couple out there, services I'm not familiar with, that offer that level of granularity. And next time I pick Mr. Cott's brain, maybe when he's not too busy to do his own show on my network, which hopefully you guys have checked out. He's just too busy to come on here these days. But we'll get him on again, and I'll pick his brain about that one. All right, question from I like this handle. In the boathouse. In the boathouse. I like that. A nautical fellow, perhaps. He wants to know, this kind of gets back to what we were talking about earlier with the Morningstar rankings. Why do so few funds offer optionality? Outside of SWAN, DRS, and Gateway, there are only a few others that have any substantial AUM or history. Why such a sparse playing field? Well, look, Matt, this kind of gets back. This is kind of the inverse of what you were just saying. You were just saying you think the field has exploded. Mr. or Mrs. in the boathouse says they don't feel that way, sir. What do you have to say for them? Do you think it's a sparse playing field, sir, like they do?
Well, I think what he's saying is it's sparse when you're looking at its substantial history or assets under management outside of SWAN and Gateway, of course. So, and I think the answer to that is, people are learning and they're starting to want to have optionality in their portfolios. Before, they would just listen to Buffett and just be long. But now people, after 11-year bull market, they're starting to say, well, wait a second, I'd like to protect some of these gains. If the market goes down 40%, I don't want to lose $400,000 on my $1 million portfolio. I'd like to only lose $100,000 or something like that. So now they're starting to get a little bit more interested, and that's why I think we're seeing more of a boom for these option-related funds, Mark.
Mr. Director of Risk, same question for you. Do you agree with In the Boathouse that it's a sparse playing field, sir?
Yeah, I have to reiterate exactly what Matt just said. So I think it's people are learning more. They're more comfortable, and they're using options. They're not speculative anymore. They're actually valuable vehicles for capital preservation and for income.
Wow, I was having so much fun with these questions, I didn't even realize that we were up against it. Unfortunately, listeners, it's hard to believe that the show's already done. We could do another 100 questions. I'd be willing for it. Blame the Director of Risk. He's got to go direct that risk. After all, we love you. In fact, let's leave it with this. Let's leave it with some love before we toss it to everybody. Let's leave it with some love. This comes from Tom Madison. And Tom Madison says, RIA should get CE credits for listening to this show. It's amazing. You guys rock. Well, thank you, Tom. And no, you guys rock for sending in all those awesome questions. Keep them coming. We love all of you. Clearly, you guys love the show. It's a mutual love fest here on the show. So let's keep it rolling. But before we do, we got to go back out around the horn, see what everybody else has cooking that may interest you. Let's start with the Director of Risk. You guys got to watch out sending all these questions in for the Director of Risk. He's going to get a big head, listeners. Also, have to start going through his agent to get him on the show. It's going to be crazy. But before we get to that level, Mr. Director of Risk, sir, folks, they want to learn more about the DRS. They want to learn more about what you guys are doing. Maybe they want to check out some content over there in Swanland. Where should they go? What should they do, sir?
Yeah, before I get to that, what I have gotten out of this show once theoretically was a steak dinner from a VIX bet, which I still have not been able to cash in on yet. You got to come to the Continental 48
to collect, sir.
Yeah, so I think there may be a little event in a few months here in the spring that maybe I get to finally collect on that one. But I won't mention who owes me It may be somebody on this show. I'm not quite sure. Anyways, yeah, going back to the original thing, we just put out a new piece called The Dangers in High Yield Bonds and CLOs. Takes a look at how investors in this space have always emphasized higher levels of income or growth rather than capital preservation. And then, as always, all the great material that we have on our website, swanglobalinvestments.com.
Check it out. A lot of good stuff there. Like you guys are always asking us for content to digest in between shows. Of course, we like theoptioninsider.com. We're kind of partial to that one, but Swan Global Investments has a lot of great stuff you guys can digest in between shows, including their research reports, their white papers, their blogs. I think we have a question about the Director of Risk and his posting, or perhaps lack thereof, on the Swan website. We'll get to that next show, unfortunately. And Mr. Matt, you're kind of the keeper of the data. You guys have a ton of stuff folks might want to sink their teeth into in between episodes. So if they are so inclined, well, first off, what do you guys have cooking? I heard whispers of some international dividends, sir. And then if they want to check that out, where should they go? What should they do?
Yeah, we just released international dividends. We're excited about that through our partner Woodseer. And we're getting into AI on all our data and finding the best times to trade these particular strategies, back testing all those strategies, and we're getting some very good results. And then we've built scanners and exit scanners to monitor those results and implement these strategies, sending it to a monitor and then sending it to the market. So, the Cirilli folks said, you got to make it easier for RIAs. You got to make it better, and that's what we're trying to do. Our mission is to bring options to the world, Mark, and we're doing it one step at a time here on the old Option Advisor.
I like that. You should make that the tagline over there at ORATS. Bringing options to the world. I like it. Check it out for yourself. ORATS.com. ORATS.com is the place to go. Give them a follow while you're at it on the old Twitters. It's at Option Rats. Easy to remember. And also, Swan Global. Give them a follow over there while you're at it as well. Whatever you do, don't follow Mr. Eric Kott, because he wasn't on the show today. But you should check out his show that he's doing. If you want more content in between episodes, sounds like a lot of you do. Hopefully you've checked out Coffee with Kott. If you're subscribed to our full network, it's available already. You have it. If not, subscribe to our full network, because there's a lot of great content on it, not just Eric's show. And, of course, you can always head on over to optionseducation.org to learn more there as well. And on behalf of Mr. Kott, who's out there somewhere, I don't know where he is, and indeed the Director of Risk, and Mr. Matt, and indeed myself, I thank all of you out there for downloading, streaming, subscribing, for sending in so many excellent questions. Keep them coming. It truly is overwhelming, the response to this show. We love it, and we'll see you back here next time for more of The Advisor's Option.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.